There's a subtle break forming inside the financial system, one that does not announce itself through headlines or dramatic movements. It is appearing instead through quiet inconsistencies, through small divergences that most observers would normally dismiss as noise. Yet those inconsistencies are accumulating, and their persistence is what gives them meaning. Markets are still functioning, trades are still clearing, and narratives are still being broadcast with confident language. But beneath that surface, the internal alignment of capital has begun to shift. When assets that once moved in unison start to drift apart, it is rarely random. Gold and silver have historically shared a common monetary gravity. They have been used, traded, hoarded, and trusted under similar conditions for centuries. Their correlation is not simply mathematical, but behavioral, shaped by how human systems respond to uncertainty. What has changed is not their physical nature. What has changed is the system that now interacts with them. That system is operating under pressures it no longer openly acknowledges. This is not visible to most participants because the dislocation is not loud. It does not come with panic or crisis language. It comes with subtle behavioral shifts, with delayed reactions, with quiet repricing in certain channels, while others remain artificially calm. The divergence between gold and silver is one of those quiet signals. It does not look dramatic, but it is deeply informative. It suggests that different layers of the monetary system are now pulling on each metal in different ways. This is not a story about one asset outperforming another. It is a story about how stress moves through a financial system when its structure is under strain. The metals are not the cause. They are the instruments being pulled by forces elsewhere. Most observers are trained to look for sharp movements. They are trained to notice spikes, crashes, or news-driven volatility. But systemic shifts rarely arrive that way. They arrive through persistent misalignment, through assets that stop behaving as expected. When gold and silver begin to reflect different realities, it implies that the system itself is no longer speaking with a single voice. It implies that different classes of capital are reacting to different forms of risk. This is where the signal begins. Not in price, not in headlines, but in behavior. And behavior, when it changes quietly, is usually responding to something that cannot yet be said out loud. The present environment cannot be compared to recent years because the system is no longer merely absorbing shocks. It is carrying accumulated strain. Structural exhaustion does not manifest through sudden collapse, but through declining resilience. For a long time, financial systems were able to respond to stress by expanding balance sheets, by lowering the cost of money, and by reassuring markets through coordinated action. That toolkit still exists, but its effectiveness has been quietly diluted. Institutions now operate with far less margin for error. Debt levels are higher, liquidity channels are more fragile, and the credibility of policy tools is no longer assumed. What once worked reliably now produces diminishing results. This changes how capital behaves. Investors, funds, and institutions are no longer simply reacting to economic cycles. They are reacting to the stability of the system that defines those cycles. Gold and silver are embedded in this process because they sit at the intersection of trust and liquidity. They are not merely commodities. They are monetary instruments that respond to the perceived integrity of the system itself. In prior periods, both metals tended to move together because they were responding to the same dominant force. That force was typically inflation risk, currency debasement, or financial instability. The signal was unified. What is different now is that the system is fragmenting. Different parts of the financial architecture are under different types of stress. Some are facing liquidity strain, others face solvency concerns, and others face credibility erosion. Gold is primarily held and traded within institutional, sovereign, and long-term capital frameworks. Silver, while also monetary, is far more exposed to industrial demand, paper market leverage, and speculative positioning. These two structures are no longer responding to the same incentives. This divergence is not a temporary distortion. It reflects how the system is being stretched in multiple directions at once. Capital is no longer moving as a single coordinated flow. It is becoming segmented. When systems enter this phase, traditional correlations begin to weaken. Assets that once mirrored each other begin to express different layers of risk. This is not because their intrinsic properties have changed, but because the financial architecture around them has. What we are observing is not a market anomaly. It is a signal of systemic complexity increasing under stress. And complexity, when it grows inside a strained system, tends to produce unpredictable and uneven outcomes. Gold and silver are now responding to different forms of pressure. That is what makes their divergence meaningful. When monetary systems begin to strain, they rarely announce that condition through immediate crisis. They signal it through behavior, especially through the way capital starts to separate into different categories of perceived safety and risk. Across modern financial history, there have been several periods where gold and silver stopped moving in parallel long before broader instability became visible. These moments were not interpreted correctly at the time because the system still appeared functional. One such period emerged during the final years of the Bretton Woods framework. Officially, the global monetary system was stable, currencies were pegged, and trade was expanding. But beneath that surface, central banks and sovereign institutions were quietly repositioning their reserves. Gold was being accumulated and repatriated, not because of inflation, but because of rising doubt about the sustainability of the dollar-based settlement structure. Silver, however, remained far more anchored to industrial usage and commodity trading. It did not reflect the same level of institutional concern until the monetary framework itself began to fracture. The divergence was not an error in pricing, it was a reflection of where stress was being perceived first. A similar pattern appeared during the prolonged inflationary environment of the 1970s. Gold began to attract capital long before inflation became politically unmanageable. Institutional investors and sovereign actors were responding to the erosion of currency purchasing power and to policy credibility risks. Silver, in contrast, remained entangled in manufacturing demand, inventory cycles, and futures market positioning. Only after monetary instability began to distort the real economy did silver shift into a more overt monetary role. Again, the lag was not random, it was structural. Another example occurred around periods of acute financial crisis in the late 20th and early 21st centuries. During episodes of banking stress and credit contraction, gold tended to move first as confidence in financial intermediaries weakened. Silver often lagged because it was more exposed to economic slowdown and to the forced liquidation of leveraged positions. Once policy responses stabilized markets, silver would sometimes catch up, but the initial divergence was always telling. It revealed which form of capital was responding to trust erosion and which was still being governed by market mechanics. These historical episodes share a common theme. When confidence in the monetary system begins to erode, capital does not move uniformly, it separates. Assets that represent monetary sovereignty attract attention first. Assets that sit between monetary and industrial roles respond later, after stress moves from financial architecture into broader economic activity. This pattern is not widely discussed because it does not fit into the conventional narrative of synchronized market movements, yet it is one of the most reliable ways to detect early-stage systemic strain. The metals are not leading or lagging in a competitive sense. They are reflecting different layers of the same underlying pressure. What makes the present divergence meaningful is not that it has happened before, but that it is happening again under conditions of extreme system leverage and institutional dependency. History does not repeat mechanically, but it often rhymes structurally. When gold and silver begin to part ways, it usually indicates that the system is no longer speaking with a single unified voice. The dominant signal moving through the global financial system is not inflation, recession, or growth. It is the gradual erosion of monetary trust. Trust is the foundation upon which all modern financial systems operate, yet it is also the least visible component. It does not break suddenly. It thins. It weakens. It becomes conditional. In a stable system, trust is implicit. Market participants assume that currency will retain value, that debt will be honored, that institutions will remain solvent, and that policymakers will act within predictable boundaries. When this trust is intact, capital flows freely through banks, bonds, and equities because the underlying architecture is taken for granted. When trust begins to decay, behavior changes before language does. Institutions do not announce that they have lost confidence in the system. They simply begin to behave as if they no longer fully believe in it. Reserves are adjusted, counterparty exposure is reduced, liquidity is held more tightly. Assets that rely on promises become slightly less attractive than assets that exist outside the promise structure. This is where gold becomes relevant. Gold is not valuable because it generates income or because it is productive. It is valuable because it does not depend on anyone else's ability to perform. It is not a claim, it is a possession. When trust in financial promises weakens, even marginally, gold begins to absorb that anxiety. The crucial point is that this process does not require panic. It does not require headlines. It does not require visible crisis. It only requires that enough large actors quietly decide that the system's future stability is less certain than its present appearance suggests. Silver also possesses monetary qualities, but it is far more entangled in the operational machinery of the financial system. It trades heavily through futures contracts, exchange-traded vehicles, and industrial supply chains. These structures delay its response to pure trust erosion because they are still governed by short-term liquidity and economic narratives. The system, in effect, is filtering risk. Gold is being used to hedge against institutional credibility. Silver is still being priced through industrial demand, speculative positioning, and financial leverage. That difference is the signal. Central banks and sovereign institutions are not abandoning the system. They are managing their exposure to it. They continue to operate within existing frameworks, but they increasingly seek assets that sit outside those frameworks as a form of balance. This creates a quiet, persistent flow into monetary metals that are perceived as politically neutral and structurally independent. Gold receives the majority of that flow because it is the deepest and most universally accepted reserve asset. Silver receives less, not because it is less monetary, but because it is more entangled. The divergence between gold and silver, therefore, is not a failure of one or a triumph of the other. It is a map of where trust is being withdrawn and where it is still being provisionally extended. The system is not collapsing. It is hedging against itself. And that is what makes this signal so important. Primary signals rarely appear in isolation. When trust begins to thin inside a financial system, it leaves traces across multiple markets, even when those markets appear calm on the surface. These traces do not point in a single dramatic direction. They quietly reinforce each other, forming a pattern of constrained confidence. Bond markets are one of the clearest mirrors of this behavior. Government debt is traditionally treated as the ultimate risk-free asset, yet it now trades under conditions where issuance volume, refinancing dependency, and political uncertainty increasingly shape demand. Investors are no longer simply evaluating yield. They are evaluating duration, fiscal credibility, and the long-term integrity of the debt structure itself. This leads to subtle distortions, where shorter-dated obligations attract disproportionate demand, while longer-dated commitments are approached with caution. That is not a normal cycle response, it is a trust response. Currency markets reveal a similar layering. Capital is not fleeing money, it is migrating within money. Certain currencies are being held not because of superior economic performance, but because of perceived institutional stability and reserve status. Others are being treated with increasing conditionality, even when their domestic indicators appear sound. This creates a hierarchy of monetary confidence that did not previously exist in such a pronounced form. Credit markets complete the picture. Lending has become more selective, more collateralized, and more sensitive to counterparty risk. Institutions are not withdrawing from risk entirely. They are pricing trust more aggressively. Spreads widen not only for weak borrowers, but for complex structures whose resilience is harder to assess. This signals that capital is no longer comfortable, relying solely on model-based stability. All of these behaviors point back to the same underlying condition. The system is still functioning, but it is doing so with a heightened awareness of fragility. Liquidity is being conserved, exposure is being managed, optionality is being preserved. Gold reflects this condition directly because it sits outside of these credit and currency hierarchies. It does not require a yield curve to be trusted. It does not depend on fiscal policy to be honored. It does not need a counterparty to remain solvent. When bonds, currencies, and credit all begin to exhibit selective confidence, gold naturally becomes more attractive as a neutral anchor. Silver, however, is still embedded within these same structures. Its paper markets are deeply intertwined with credit, leverage, and speculative liquidity. Its industrial role ties it to economic growth expectations. These connections can temporarily suppress or distort its response to systemic trust signals. The confirmation comes not from any single market, but from the coherence of their behavior. Bonds, currencies, and credit are all showing that confidence is being rationed. That is the environment in which gold diverges from silver. This is not a signal of imminent failure. It is a signal of careful repositioning. The system is quietly acknowledging that stability is no longer something to assume. And when that acknowledgement spreads across markets, it tends to surface first in the assets that are least dependent on trust. Silver occupies a structurally unusual position within the monetary system. It is both a store of value and an industrial input, both a monetary metal and a commodity embedded in modern production. This dual identity gives it a unique sensitivity to systemic stress, but it also causes its signal to arrive later and in a more compressed form than that of gold. When trust begins to erode within financial institutions and currencies, gold responds almost immediately because its only function is to preserve monetary value. Silver, however, continues to be priced through supply chains, manufacturing demand, inventory cycles, and derivatives markets. These forces can dominate its behavior even while deeper monetary pressures are building. This creates a condition where silver appears restrained or even artificially stable at precisely the moment when monetary stress is intensifying. Futures contracts, exchange-traded vehicles, and hedging programs allow large volumes of silver exposure to exist without the movement of physical metal. These paper structures act as shock absorbers, delaying the translation of monetary demand into market pricing. Historically, this suppression phase has been a recurring feature of silver behavior during periods of rising systemic risk. As gold begins to reflect institutional hedging against monetary instability, silver remains tethered to economic narratives. It is still treated as an input into electronics, energy infrastructure, and manufacturing, rather than as a monetary instrument. But this balance is unstable. As trust decay continues, the distinction between industrial demand and monetary demand becomes less meaningful. When financial risk migrates into real economic channels, silver's industrial identity no longer shields it from monetary stress. At that point, the paper structures that once stabilized it begin to strain. This is why silver's repricing, when it arrives, is often sudden rather than gradual. The market does not slowly adjust. It reconfigures. Liquidity thins, inventories become more relevant, and the gap between paper claims and physical availability begins to matter. The current divergence between gold and silver suggests that this process is still in its earlier phase. Gold is being pulled by institutional hedging against trust erosion. Silver is still being held in place by the mechanics of industrial supply and financial leverage. That does not make silver less relevant. It makes it more diagnostic. Its delayed response highlights the tension between monetary stress and economic narrative. It shows where the system is still able to manage appearances and where it is not. Hard assets behave differently under these conditions, depending on how deeply they are embedded in financial infrastructure. Gold sits outside most of it, silver sits inside much of it. That is why their paths can diverge even when they are responding to the same underlying force. This is not a breakdown of correlation, it is a layering of response. And that layering is one of the clearest ways to observe how stress is traveling through the system. When financial systems enter periods of prolonged strain, the most important responses are rarely mechanical. They are psychological and institutional. The way risk is perceived, narrated, and managed becomes as significant as the risk itself. Stability in such environments is maintained not only through liquidity and policy, but through confidence engineering. Governments and central banks are structured to prevent disorder. Their primary function during periods of systemic stress is not to eliminate risk, but to prevent the recognition of that risk from becoming destabilizing. This leads to a pattern of delayed acknowledgement, where underlying imbalances are addressed quietly while public communication remains focused on continuity and control. Policy tools in this environment are often used defensively. Interest rates, asset purchases, regulatory adjustments, and liquidity facilities are deployed not just to influence economic outcomes, but to manage market psychology. These interventions are designed to keep participants operating within the existing framework rather than questioning it. This creates a surface of normality even as internal pressures build. Financial institutions continue to transact, capital continues to circulate, but the basis of that circulation becomes more conditional. Risk committees tighten, counterparty limits are adjusted, collateral requirements increase. None of this is dramatic, but all of it reflects a subtle shift in trust. Investors respond in a similar way. They do not abandon markets wholesale, they become more selective. They seek diversification not only across assets, but across systems. Holdings are adjusted to include instruments that are less dependent on financial intermediaries and policy stability. This is not fear-driven behavior. It is insurance-driven behavior. Gold fits naturally into this pattern because it allows institutions to hedge without making an overt statement about distrust. It is politically neutral, globally liquid, and structurally outside the credit system. Accumulating it does not require a narrative of crisis. It can be framed as prudent reserve management. Silver does not enjoy the same institutional invisibility. Its markets are more volatile, more speculative, and more visibly connected to industrial demand. That makes it less convenient as a quiet hedge for large entities, even when it shares many of gold's monetary properties. Narrative control plays a central role in this dynamic. Authorities emphasize resilience, growth, and adaptability. They avoid language that would suggest fragility. This does not mean they are unaware of risk. It means they are managing how that risk is perceived. Markets learn to operate within these narratives. Volatility is interpreted as temporary. Structural issues are reframed as cyclical. This keeps capital engaged, but it also creates a disconnect between official messaging and private positioning. The result is a dual reality. Publicly, confidence appears intact. Privately, hedging behavior increases. Gold reflects the private reality. Silver remains more exposed to the public narrative. Over time, this gap can widen. The longer stress persists without resolution, the more capital seeks refuge in assets that do not require institutional credibility. This is not a rush, it is a drift. Understanding this psychological landscape is essential to interpreting why gold and silver are behaving differently. It is not because one is right and the other is wrong. It is because they are embedded in different layers of perception and control. The system is not breaking, it is coping. And the way it copes reveals where pressure is truly accumulating. When trust erosion continues without being structurally resolved, financial systems tend to move into a phase of persistent instability rather than immediate breakdown. This instability does not usually appear as a single catastrophic event. It manifests as repeated episodes of volatility, liquidity stress, and policy intervention that gradually reshape how capital behaves. One of the first consequences is a decline in the reliability of traditional correlations. Assets that once moved together begin to diverge, not because their underlying economics have changed, but because different types of capital are now reacting to different forms of risk. Equity markets may remain buoyant, while bond markets show unease. Currencies may appear stable, even as reserve accumulation patterns shift. These inconsistencies make the system harder to interpret and harder to manage. Liquidity becomes increasingly selective. It does not disappear, but it concentrates. Capital flows towards structures perceived as resilient and withdraws from those that appear vulnerable to policy shifts or institutional failure. This can lead to sudden funding pressures in areas that previously seemed secure. The system remains liquid in aggregate, but brittle in distribution. Policymakers respond to this environment by attempting to smooth outcomes. They adjust rates, expand balance sheets, or modify regulations to contain visible stress. These actions can stabilize markets in the short term, but they also increase the system's dependence on intervention. Over time, this creates a feedback loop where markets become less capable of functioning without support. As this dependency grows, the credibility of policy tools becomes more important. If interventions are seen as effective, confidence can be maintained. If they are seen as insufficient or politically constrained, trust erodes further. This dynamic does not move in straight lines. It oscillates. In such conditions, assets that embody monetary independence gain relevance, not because they promise returns, but because they offer continuity when institutional structures feel uncertain. Gold typically reflects this first. Silver follows later, once stress moves beyond financial channels into economic and social ones. The divergence between gold and silver, therefore, is not a side effect. It is part of how the system processes unresolved strain. It indicates that capital is already preparing for outcomes that have not yet been acknowledged publicly. This does not mean a specific outcome is inevitable. Systems can adapt, they can reform, they can find new equilibria. But adaptation under strain is rarely smooth. It produces transitional phases where old relationships weaken before new ones stabilize. If the current signals persist, the financial landscape is likely to become more fragmented, more volatile, and more dependent on confidence management. That environment favors assets that are simple, liquid, and independent of institutional promises. The story is not one of collapse, it is one of reordering. And reordering, when it occurs under pressure, leaves traces long before it becomes visible. The divergence between gold and silver is not a technical anomaly or a temporary distortion. It is a behavioral imprint left by a system adjusting to pressures it has not yet fully acknowledged. When assets that once moved together begin to express different realities, it suggests that capital itself is no longer unified in how it interprets risk. Gold is responding to something subtle but persistent. It is absorbing the quiet withdrawal of trust from institutions, currencies, and policy frameworks that once appeared unquestionable. Silver, still bound to industrial narratives and financial structures, reflects a world that continues to operate as if those foundations remain intact. Neither view is entirely wrong. They are simply different layers of the same system. One layer is preparing, the other is maintaining. This is why the divergence matters. It is not telling us what will happen. It is telling us how the system is feeling. And systems, like people, reveal their stress through inconsistency long before they reveal it through breakdown. Throughout this analysis, the same theme has emerged repeatedly. Trust is thinning, not disappearing. Institutions are hedging, not retreating. Capital is repositioning, not fleeing. These are the behaviors of a system that is aware of its own fragility but is still functioning. Gold reflects that awareness. Silver reflects the inertia of existing structures. Between them lies the tension that defines this moment. There is no urgency in this signal. There is no alarm embedded in it. There is only information. The information is that the financial architecture is no longer being taken for granted by those who operate within it. Understanding that shift does not require action. It requires attention. The quiet signals are always more important than the loud ones because they emerge before narratives are constructed to explain them. Gold and silver are not issuing a warning. They are simply responding. The meaning of their divergence is not in the metals themselves, but in the system that now pulls on them differently. And when a system begins to speak in two voices, it is usually because it is in the process of changing, even if it has not yet decided what it will become.